Every single day on Wall Street and across global markets, literally trillions of dollars change hands in this relentless, high-stakes tug-of-war. For some people, this arena is just a chaotic casino, right? Frantic trading, flashing red and green screens, and a whole lot of shattered dreams. But for a quiet, highly disciplined few, it's the ultimate engine for financial freedom. Welcome to this explainer. Today, we're going to shatter the illusion that wealth requires timing the perfect trade. Instead, we're revealing the true mechanics of lasting financial independence. So let's dive right in and uncover the actual blueprint for your financial future.
I want you to imagine waking up, opening your portfolio, and seeing this. Negative 50%. Half of your hard-earned money just vanished into thin air. Whether it was the gut-wrenching 2008 financial crisis in the US that sent shockwaves around the globe, or that sudden, terrifying plunge we all saw in the spring of 2020, extreme market wipeouts are an undeniable reality of investing. And look, that sudden drop triggers a visceral, almost physical pain. The sheer panic of sudden volatility is the ultimate test of an investor. And sadly, it's the exact moment where the vast majority of people make a totally fatal financial mistake. So this brings us face to face with a puzzle we really need to figure out. Why do so many everyday people consistently fail to build wealth? I mean, why do they constantly lose money in the markets despite this absolute ocean of information we have today? We live in an era of unprecedented access. Think about it. You have more financial data on the smartphone in your pocket right now than legendary investors had in their entire offices a few decades ago. So the answer isn't a lack of data. No, it's something far more deeply rooted in our own human nature.
Section 1. The Modern Market Minefield.
To actually understand why we fail, we first have to understand the battlefield itself. And let's be honest, the modern market is, quite frankly, a minefield. But the explosives aren't hidden in the balance sheets of companies. They're actually hidden right inside our own minds. There's a clear line in the sand here between two entirely different approaches to money. On one side, we got the emotional investor. This person is driven by frantic habits, reacting to every single news headline, paralyzed by fear during a downturn, and totally blinded by greed during a rally. On the other side, we have the disciplined investor. This individual approaches the market with a grounded, patient methodology. They don't just react, they respond based on a predetermined plan. The biggest difference between these two? It isn't intelligence. It is 100% self-control.
Section 2. Panic, greed, and emotion.
Panic, greed, and emotion aren't just feelings, you guys. They are the active destroyers of your portfolio. Let's watch how this actually builds in real time during a market crash. The anatomy of a panic sell-off is tragically predictable. Step 1. The euphoric peak. Everyone's making money, the market's soaring, and honestly, you feel like an absolute genius. Step 2. Bad news breaks. A geopolitical event, an economic report, something unexpected hits the tape. Step 3. Fear takes over. The market starts dropping day after day. The media is screaming that it's the end of the world. And then, the fatal climax. Step 4. Panic selling at the bottom. The emotional investor simply cannot take the pain anymore. They log in, sell everything just to stop the bleeding, and in doing so, they literally turn a temporary paper loss into a permanent, devastating reality. They sell exactly when the disciplined investor is getting ready to buy.
This emotional hijacking, it leads directly into a series of catastrophic traps. First up is overtrading. Constantly buying and selling, racking up fees and taxes while chasing this illusion of control. Second is ignoring diversification, basically putting all your eggs in one highly speculative basket. Third is the absolutely lethal myth of market timing, believing you can consistently guess exactly when to jump in and out. And finally, investing without research, just throwing money at a company because you recognize the logo rather than actually understanding the business. These are the classic pitfalls that swallow ordinary wealth whole.
Section 3. The Social Media Hype Trap.
Today, those traditional pitfalls have been completely supercharged by a modern danger. It's no longer just a hot tip whispered by a neighbor. It's a deafening roar from millions of voices online telling you what the next sure thing is. And here's an insider secret we really need to unpack. Chasing the hype usually means buying the top. By the time a stock is trending on your social media feed, by the time your barista and your dentist are bragging about their overnight gains, the smart money has already made their profit. If you're buying based on virality, you are not an early adopter. You are the exit liquidity for the people who got in months ago.
The mechanics of this are entirely predictable. It's a vicious loop known as the hype cycle. Step 1. A viral trend erupts online, usually completely detached from any fundamental business reality. Step 2. FOMO, the fear of missing out, kicks in hard. Everyday people see the charts going parabolic and they buy in sheer panic, absolutely terrified they're going to be left behind. Step 3, the inevitable crash. The hype fades, the early buyers cash out, and the price just plummets back to earth, leaving the emotional investor holding a worthless bag. This cycle is pretty much the exact opposite of actual financial research.
Section 4. The blueprint for true wealth.
Sir, if the modern market is this crazy minefield of emotion and hype, how do we actually navigate it? How do we stop being victims of volatility and start becoming the architects of our own wealth? Well, we shift our focus, slow our pacing down, and look at the actual blueprint for the disciplined investor. Look at the long-term trajectories of real-world titans: Apple, Microsoft, Amazon, Nvidia, Tesla. If you zoom in on any given month or even a year in their histories, you're going to find terrifying crashes. We're talking 30, 40, even 50% drops. But zoom out over decades, what do you see? Massive, undeniable compounding growth. The disciplined investor who held these companies through the dot-com bust, the 2008 crisis, and the 2020 crash was immensely rewarded. This proves, visually and mathematically, that patience rewards the disciplined investor over time. As the saying goes, the bumps on the road don't matter if you never get out of the car.
Which means we need to fundamentally redefine how we view the market as a whole. See, we're taught to fear volatility, right? That day-to-day bouncing of prices, but real risk is not temporary volatility. Real risk is the danger of permanent capital loss. And permanent loss usually only happens when an emotional investor panic sells at the very bottom or buys into a doomed hype cycle. Those terrifying short-term drops, they are just the price of admission you pay for massive, life-changing long-term gains. Volatility isn't your enemy. Actually, it's your opportunity.
Let this quote anchor your entire financial strategy moving forward. Wealth is built through patience, discipline, and long-term holding, not frantic trading. You don't need a PhD in finance to do this. You definitely don't need a crystal ball. You simply need the emotional fortitude to ignore the noise, do your research, diversify, and let time do the heavy lifting for you. Ordinary people absolutely can become architects of their own wealth. It just comes down to mastering emotional control.
The market is always going to have its dramatic ups and downs. Hype cycles will come and go. Crises will inevitably emerge. The variables of the world are entirely out of your control, but your reaction to them? That is completely within it. You've seen the pitfalls, and you've uncovered the blueprint. So I'm going to leave you with this final, vital question to think about. What kind of investor will you choose to be tomorrow?